Understanding financial mechanics. Understanding the federal funds rate, a must-know for investors. In the realm of finance and investment, few concepts are as crucial to grasp as the federal funds rate. This pivotal interest rate has far-reaching implications for both macroeconomic conditions and individual financial decisions. In this session, we will break down the significance of the federal funds rate, explore its components, and discuss how it impacts various aspects of the economy, including inflation, borrowing costs, and investment returns. Breaking down the significance of interest rates. What is the federal funds rate? The federal funds rate is the interest rate at which banks lend reserves to one another overnight. This rate is determined by supply and demand for reserves in the banking system and is a critical tool used by the Federal Reserve, the central bank of the United States, to implement monetary policy. Changes in this rate influence overall economic activity by affecting other interest rates, including those for loans, mortgages, and savings accounts. The role of the Federal Reserve. The Federal Reserve adjusts the federal funds rate in response to changing economic conditions. When the economy is expanding too quickly and inflation threatens to rise beyond target levels, the Fed may raise interest rates to cool off spending and borrowing. Conversely, in times of economic downturn or recession, lowering interest rates can stimulate borrowing and investment, encouraging growth. Impact on borrowing costs. The federal funds rate serves as a benchmark for other interest rates throughout the economy. When this rate rises, it generally leads to increased borrowing costs for consumers and businesses alike. Loans for homes, cars, and credit cards typically see higher interest rates in response to Fed increases. For investors considering leveraged investments or large purchases financed through debt, understanding these dynamics is essential for making informed decisions. Influence on savings accounts and investments. Changes in the federal funds rate also affect interest earned on savings accounts and other fixed income investments. When rates are high, savers may benefit from better returns on savings accounts or certificates of deposit. Conversely, lower rates may result in diminished returns from these traditional savings vehicles. As a result, investors must adjust their strategies accordingly when making decisions about where to allocate capital. Effect on stock market performance. The stock market is often sensitive to changes in interest rates due to their impact on corporate profitability. Higher interest rates increase borrowing costs for businesses, which can pressure profit margins and ultimately lead to lower stock prices. On the other hand, lower rates tend to enhance market liquidity and boost corporate earnings by making debt financing cheaper, leading many investors to closely monitor Fed announcements regarding potential rate changes. Understanding inflation dynamics. Interest rates are intricately linked to inflation levels within an economy. The Fed aims to maintain a target inflation rate, often around 2%, that promotes price stability while fostering economic growth. When inflation rises above this target level, typically due to high consumer demand, central banks may raise interest rates as a countermeasure to prevent an overheating economy. Long-term implications for investment strategy. Savvy investors understand that predicting movements in interest rates can offer insights into future market conditions. Thus, integrating knowledge about the federal funds rate into investment strategies not only provides context, but also enables informed decision-making concerning asset allocation across equities, bonds, real estate investments, and alternative assets. Understanding the federal funds rate simplified. While understanding the mechanics behind the federal funds rate can seem complex at first glance, simplifying its relevance helps individuals relate changes in this rate to their personal financial decisions. Relating interest rate changes to personal finance decisions. Impact on personal loans. When contemplating a mortgage or personal loan, individuals should consider prevailing interest rates as influenced by Fed actions. For example, if you plan to buy a home during a period of rising interest rates, securing a fixed-rate mortgage before further increases can be beneficial. Locking in current rates minimizes long-term costs. Credit card interest rates. Most credit card companies set their interest rates based on prevailing market conditions, influenced by changes in the federal funds rate. Thus, understanding this connection is vital. If borrowing becomes more expensive due to rising rates, it's crucial to prioritize paying down existing credit card debt before accruing higher interest charges further erodes financial stability over time. Saving strategies. Savers should evaluate how shifts in the federal funds rate affect their savings accounts and other cash equivalents over time. During periods of rising interest rates, utilizing high-yield savings accounts or CDs may provide favorable returns compared with traditional low-interest accounts, maximizing growth potential while minimizing risks associated with fluctuating equities. Investment choices. For individuals focusing on investments beyond traditional savings options, analyzing how expected changes in Fed policy affect various asset classes becomes essential. Stocks may become less attractive during economic slowdowns when higher borrowing costs negatively impact corporate earnings. Therefore, diversifying into alternative investments, for example, bonds or commodities, could mitigate risks posed by unfavorable market conditions. Budgeting for increased expenses. As personal loan costs rise largely due to tightening monetary policies initiated by central banks, it's prudent to anticipate potential increases across all areas, including housing expenses. Making adjustments within monthly budgets accordingly ensures individuals maintain adequate cash flow amidst rising financial pressures from escalating expenses while avoiding pitfalls associated with debt overload. Future financial planning. Changes in interest rates often lead individuals back towards reassessing long-term financial goals, whether that means altering retirement contributions based upon shifts within 401k investment options offered through employers amid volatile equity markets, or re-evaluating educational saving plans designed specifically for children. Staying flexible becomes paramount, ensuring each decision made supports overall objectives optimally. Staying informed. Finally, remaining educated about upcoming meetings conducted by the Federal Reserve, along with analyzing comments made by key policymakers surrounding monetary policy, provides insights allowing individuals gauge future trends accurately while adapting approaches accordingly. Subscribing news alerts focused specifically on economic developments equips individuals with relevant context, enabling proactive decision-making, leading ultimately towards achieving desired outcomes financially. In summary, understanding financial mechanics surrounding concepts like the federal funds rate empowers not just investors, but also everyday consumers seeking to navigate changing economic climates effectively. By correlating movements within this crucial metric back towards personal finance decisions, as well as acknowledging how they directly impact key areas such as borrowing costs and saving strategies, allows individuals foster greater confidence throughout their journeys toward achieving enduring financial success. Through proactive awareness, everyone stands equipped to leverage knowledge alongside strategic action, taking control over financial futures while adapting skillfully alongside evolving economic realities.